Once we've created our financial statements, there's one more step that we need to complete, well, or I guess two really, but sort of one process that's got two pieces to it before we are ready to then start the next accounting period. Come on. And that is to go through the closing process. Now, there are temporary accounts and permanent accounts. The only balances we are going to close are the temporary accounts. And those accounts are our revenue, expense, and withdrawal accounts. And we are going to reset those back to zero. We've updated in terms of financial statements, the owner's capital account reflects, or the statement of owner's equity, reflects the net income, but we need to make sure that the account itself, the owner's equity account, reflects the addition of the net income that we had used on the balance sheet. So the closing process requires us to identify the accounts for closing. And again, we've got these three types here. Revenue, expense, and owner's draws. We're going to record and post the closing entries, and now we are going to prepare yet one more trial balance, and now that's called the post-closing trial balance. So you will have prepared a total of 3 trial balances as part of the accounting cycle. You had your first unadjusted trial balance, then you made your adjustments where you then prepared the adjusted trial balance. Now you're going to do your closing entries, and finally you will prepare the post-closing trial balance, which will assure us that we have in fact closed all the accounts that are temporary and need to be closed. And so let's talk just for a second about why we're closing the accounts, the temporary accounts that we have on here. And I guess often the most meaningful example I can create for students is your paycheck. Your company gives you a paycheck, and it's probably got a year-to-date figure on it that every time you get paid, that year-to-date figure goes up and up and up, and then you get to December 31st and it shows the year-to-date how much you've been paid for the entire year. Then we get to January. Well, January, we don't just add to the prior year's figure, we start over with 0. And that's what we're doing with the revenues, with the expenses, and the owner's draws. And in order to do that, we use a brand new account you haven't seen yet called the income summary account. The assets, liabilities, and owner's capital, those are permanent accounts, and we are not going to zero those out. So the first thing that we have to do is we are going to close our revenue accounts to the income summary account. And I'll show you this in a second, but we'll just talk through it first. You're going to close the revenue accounts to the income summary. Then you're going to close the expense accounts to the income summary. Then you're going to take the income summary account itself and close that into the owner's capital account, and then close the withdrawals also to the owner's capital. So let's see what that really looks like. We've got over here our revenue accounts, and between the two revenue, so we've got 78, 50, and 300 from our two sources of revenue for a total of 8,150, and those are credit balances. Every time we earned revenue, we entered a credit, and so those are credit balances. So now if we want to close this account, if we want that account to be at 0 after this process, what do we need to do to make those revenue accounts 0? And the answer is that we have to enter debits that equal those credits so that then the balance is 0 in our revenue accounts. So you will enter a debit for, in this case, we have 2 separate revenue accounts, to 0 those out. But then what do? You've got these 2 debit entries that you've made, you're out of balance. Somewhere, somehow, you've got to enter a credit someplace else that will cause the transaction not to be out of balance. And that someplace else is the income summary account. So it's just going to be a temporary holding tank for the closure of the revenue and expense accounts. And so that credit goes into the income summary account, and now our revenue account is at 0. Similarly, we go over here to the expense accounts. Now those all had debit balances as we were entering the transactions. So if we want to zero out every single one of these accounts, we've got to enter a credit on every single one of these accounts to now make them 0, so that when we start over next year, all we're worried about are next year's expenses and not, cluttered up expenses from leftover from this year. So we want them to be at 0. All of those credits then get entered, and then we need a corresponding debit someplace, and wouldn't you know, that income summary account serves the purpose. So we now have a balance in our income summary account after having closed out our revenue and our expense accounts. And what is that balance? $3,785. Well, hopefully that is a number that you have seen somewhere else before. We've used a consistent set of transactions throughout these first few chapters, and hopefully you will recognize this number as the net income figure that we had. And of course it is, because all that is the difference between the revenue and the expenses, and that gets us to net income. So now we need to somehow get that net income into the owner's equity account. And so this is how we do that. We now need to zero out the income summary account, because we're all done with that. We're going to tuck it away till next month when we need it. And to do that, we are going to enter a debit for $3,785. And then we've now made the income summary account 0, but we need a credit someplace else, and that credit goes into the C. Taylor capital account. And that's how C. Taylor's capital account is increased by the owner's equity. So what this is doing is taking what you have done on those financial statements, what you've reflected, and actually made sure that the money is really in his account and not just on the statement someplace. Now, Mr. or Ms., I can't remember, Taylor also took $200 out of the company, and we want to wipe out the withdrawal account. So there was a $200 debit balance in there when we prepared the financial statements. So to zero out that account, we put a credit for $200. We got to have a debit someplace else, and lo and behold, that's going to be in our C. Taylor capital account, which will reduce the balance in that account to reflect the fact that $200 had been taken out of it. And now our withdrawal account is at 0, our expense account's at 0, our revenue account's at 0, and the income summary account's at 0. C. Taylor Capital's account has now been updated for everything that has occurred that has impacted the capital accounts, and we are ready to start over fresh in the next accounting period. And in order to just make that double check that we are in fact ready to start over fresh, we're going to prepare that final trial balance, that post-closing trial balance, just to ensure that the permanent accounts are still there, that we didn't accidentally screw up and close out a permanent account, that our debits and credits still equal, so that as we're going into the next accounting period, we know we're in balance going forward, so we don't start off with bad numbers, and then to confirm that the temporary accounts have a 0 balance. So here is our post-closing trial balance. All that we have left are our permanent accounts, our assets, our liabilities, and our owner's equity. And so the only thing that's different here from the adjusted trial balance that we had previously is there are no more temporary accounts, and the C. Taylor capital account has now been updated to reflect the net income and the withdrawal that C. Taylor took during the month. And this is kind of a slide that takes you through from the source documents and analyzing the transaction all the way through to the post-closing trial balance that we just talked about. And this slide is just way too little for me to try and go through that with you, but it's in your book and it's just a recap of what we just talked about. So I'm going to stop this video here and go on to the next video for the discussion of the classified balance sheet.